Annenberg Media.
How many U.S. dollars can you get for a British pound? How many Japanese yen for a German mark? And what difference does it make to business? Fixed versus floating exchange rates. Who sets, who should set exchange rates? Governments or private markets? We'll find out when we look inside the global economy.
In this segment of Inside the Global Economy, we're going to be looking at exchange rates. What are they? What affects them? What impact do they have on the economy? And we'll give you a flavor for one of the big economic debates of the 20th century, which is, should we fix exchange rates within narrow bands or let exchange rates fluctuate and let the markets determine where exchange rates will go? To illustrate some of these points, we're going to look at two case studies, one which will show the benefits of floating exchange rates, and the second which will show the costs of fluctuating exchange rates. We'll also hear from a panel of experts about their views on these topics. But first of all, let's define some terms. What do we mean by an exchange rate? Well, an exchange rate is the price of one country's currency in terms of another country's currency, as we can see on the screen here. How do exchange rates move? Well, again, an appreciating currency is one whose value is rising relative to other currencies. In our example, if the value of the dollar is going up relative to the Deutschmark, it means a single dollar can buy more Deutschmark than it could before. So therefore, it's more valuable. If a currency is depreciating, it's less valuable relative to the other currency. So again, in our example, if the value of the dollar goes down relative to the German Deutschmark, it means the same dollar can buy fewer Deutschmark than it did before, so its value has gone down. What does the market for exchange rates look like? Here we've got a supply and demand curve for dollars and Deutschmark, and the vertical axis shows the price of the dollar in terms of Deutschmark, and the horizontal axis shows the actual quantity of dollars traded in Germany in the foreign exchange markets. Now, a couple of interesting points to be made about this particular market and relative to the graph. The first is that this is a 24-hour market. The players are banks, typically the foreign exchange desks at a bank. They're the currency traders. They're big brokerage houses and so forth that do foreign exchange transactions. There is no single market. There's no single location. It's all over the world. It's global, and it's also 24 hours. It goes on the whole time. Everybody's connected with one another through telephone lines and computers and so forth. There's another difference in this market, and that is that typically people don't buy and sell dollars or Deutschmark because they are looking for dollars and Deutschmarks per se, but because the demand and supply for foreign exchange reflect the demand and supply for goods being bought and sold in the international market, exported and imported, or they also reflect the demand and supply of foreign investment. So underlying this demand and supply curve on this graph is a whole series of transactions, which we can see on the next graphic here, which takes apart and looks at the players in the foreign exchange markets. And let's look at the supply side first. Who are the players that supply dollars in the market for dollars, let's say, in Germany? Certainly, the first set of suppliers are U.S. importers of German goods. In other words, if I as an individual or a company are buying goods, it could be Mercedes, BMWs, capital equipment, then we are basically supplying dollars to the Germans, or another way of saying it is we're giving the Germans dollars in exchange for Deutschmark, which we will use to pay for those goods. Then we are net suppliers of dollars in the German market. Also, U.S. direct investors can also be suppliers of dollars, as we can see here. By direct investors, we're talking about, let's say, Ford building a factory in Germany. It therefore wants to pay for that factory in dollars, so it supplies dollars into Germany, into the German market, to pay for that factory being built in Germany. A third, you have German investors in the U.S. that are earning dollars in the U.S. but want to repatriate those profits and those earnings, so they too are supplying dollars into Germany in exchange for Deutschmarks. Fourth, you have U.S. portfolio investors. These are people who are investing in the German stock market or the bond markets, people who want to buy, let's say, BMW stock or Siemens stock or whatever. And then finally, suppliers include what are referred to as dollar bear speculators. These are speculators who believe that the value of the dollar is going to fall relative to the Deutschmark, so they're going to be dumping their dollars. Let's look at the other side of the market. Who are the demanders of dollars? Well, to begin with, these are U.S. exporters to Germany, companies selling goods to Germany. They want their payments in dollars, so they demand dollars as payments. Second, German companies that are investing in the U.S., they're buying or building a company in the U.S., they demand dollars to make those payments. Third, U.S. companies in Germany that are earning Deutschmark profits but want to repatriate those profits to the headquarters, let's say, and they want dollars in order to repatriate the profits. So they want to exchange their Deutschmark for dollars. They too demand dollars. Fourth, you have German portfolio investors. These are investors in Germany that want to buy U.S. stocks or U.S. bonds. So they demand dollars in order to pay for those investments. And then finally, you have what are called dollar bull investors. These are speculators who actually believe the value of the dollar is going to go up, and so they jump into the market and demand dollars in order to hold dollars in anticipation of the value of the dollar rising. There's a third group in this marketplace, and they're called the market straddlers, and there are two in this grouping. Arbitrageurs. These are usually traders or brokers who are on both sides of the market trying to take advantage of either differentials in the marketplace or who anticipate that the market is going to go up someplace and will buy, let's say, dollars, or if they anticipate the dollar is going to go down for a while, they'll sell dollars, but they're in and out of the market a lot on both sides. But more importantly, the central banks are also both buyers and sellers in this market, in the sense that, for example, if the U.S. Federal Reserve believes that the value of the dollar is too high, it will sell dollars in an attempt to bring the value down. On the other hand, if it believes the value of the dollar is too low, it will buy dollars to shore it up. And the Bundesbank can do exactly the same thing. It can either buy or sell Deutschmark and dollars to affect the value of the exchange rate. Now, what are the factors that affect the foreign exchange markets and the value of foreign exchange rates? And this schematic here gives us a flavor for what's going on. To begin with, there can be economic events and policy developments that feed into what's going on in the economy, which is GDP or GNP, output, prices, the rate of inflation, and interest rates. The economic events can be things like oil shocks. They can be droughts or other events out there. On the policy front, government spending or taxes or monetary policy, credit policy, can also have an effect on the economy as a whole. Now, the output variables, output, income, prices, interest rates, then feed in to the foreign exchange market. They have an impact on foreign exchange rates, as do two other factors, namely expectations. Sometimes we expect foreign exchange rates to move in one direction or another. That can compound or amplify movements in foreign exchange rates. And the other psychological factors, maybe lack of confidence in U.S. policy or whatever, can also be an important factor. All of these then determine the supply and demand for foreign exchange, which in turn affects the actual foreign exchange rate itself. Now, this is not only true for the U.S. in our example, but for Germany. All these factors affect the exchange rate between the dollar and the Deutschmark, both on the German side and on the U.S. side. Let's see if we can give some more examples here of how some of these factors affect the market for the dollar and the Deutschmark and the exchange rate between the two. The first is interest rates. What happens when U.S. interest rates go up? Well, in this instance, what happens is that as the rates go up, the rate of return on U.S. assets, bonds, stocks, and so forth, typically rises, which makes U.S. assets more attractive worldwide, let's say relative to German assets. So German investors will buy more of these assets and in the process demand more dollars. So this is represented in this graph by a upward and rightward shift in the demand for dollars. And the result is an increase in the value of the dollar because demand has risen relative to supply, so that means an increase in the value of the dollar relative to the Deutschmark. So the exchange rate of the dollar relative to the Deutschmark goes up in this example. What about another one in which U.S. income increases? Let's say the growth rate in the U.S. is accelerating relative to Germany. We're becoming wealthier. Our incomes are going up. The transmission mechanism here is basically that as our income rises, we feel wealthier, we buy more goods, including more imported goods. In this instance, maybe more BMWs and Mercedes. And as we buy more of those goods, we pay for them in dollars, basically, or we exchange dollars for Deutschmark to pay for them. And so the supply of dollars in the world economy and in the German foreign exchange market has increased. So this is shown by a downward and rightward shift in the supply of dollars in Germany, which has the effect of depressing the value of the dollar relative to the Deutschmark because, again, more supply of dollars, the demand for dollars hasn't changed, and so that tends to have the effect of depressing the value of the dollar relative to the Deutschmark, and so it goes down. Let's look at one last example, and this is one in which the U.S. rate of inflation increases, and let's assume for the moment that the German rate of inflation does not increase. So what happens is U.S. goods become more expensive relative to German goods, which has two effects. One is it means fewer U.S. goods are being bought, and second, it means more German goods are being bought. So we see the effect of that on both sides of the market here. In terms of fewer U.S. goods being bought, the demand for dollars declines. We see that with a leftward shift in the demand curve. So fewer U.S. goods being bought, less demand for dollars. And then more German goods being bought. So therefore, the supply of dollars to pay for those German goods increases. So that's shown by a rightward shift in the supply curve. So the combination of the shift in the supply curve and the demand curve mean that the value of the dollar goes down as a result of higher inflation in the U.S. So far, we've looked at what variables affect the exchange rate, what impact this has on the exchange markets. Now let's turn the tables a little bit and look at the impact that changes in exchange rates have on the rest of the economy. And to analyze this impact, we're going to look at a case study that looks at two companies, a U.S. company, Caterpillar, and a Japanese company, Komatsu, and we'll see how the fluctuations in the value of the dollar relative to the Japanese yen had on the operations of these companies.
Who would be king of the hill in the U.S. heavy equipment market? Would it be U.S.-based Caterpillar, the industry leader? Or Japan-based Komatsu, an importer to the U.S.? The stakes were high. The American construction market. Billions of dollars in excavation and earth-moving contracts for highways, office buildings, and shopping malls. Winning would take efficiency, quality, marketing. All critical, all controllable. But what was the one factor that neither company could control? The factor that could tip the balance and save or cost the competitors billions in sales. Fluctuating exchange rates. How does business stay afloat? Since 1973, exchange rates had been set by the world's currency markets. Financiers buying and selling money, like other business people buy and sell stock or commodity futures. Determining through the forces of supply and demand how many Japanese yen it took to buy a US dollar, or how many French francs to a British pound. In the early 80s, the yen was selling low and the dollar selling high. For Japan-based Komatsu, that meant lower prices and the chance to sell a wider range of products to U.S. customers. Masahiro Sakane, president of Komatsu's U.S. operations.
Early 80, 1982年頃に
Around 1982, Komatsu began to consider exporting a full product line to the U.S. market. It was a time of a weak yen, 250 to the dollar.
150円というウィーク円の時代であったわけです。で、円が安かった当時にフルラインを決心、フルラインの
The exchange rate was meaningful because the weak yen helped Komatsu feel confident that we could offer competitive prices for a full product line.
為替の問題は非常に大きな役割を果たしたと思いますけども。
King of the Hill Caterpillar knew what the low or undervalued yen would mean to rival Komatsu. Vice Chairman James Wogsland.
If an exchange rate is 35 or a currency is 35, 40% undervalued, it means they have a 35, 40% cost advantage. And they're either going to make a lot of money or they're going to be very tough in the marketplace.
Komatsu was making a lot of money, cutting sharply into Caterpillar's U.S. market share. But the cat was not about to be bulldozed. Caterpillar streamlined operations to cut costs. Lower costs that meant lower prices for heavy equipment customers. But where could Caterpillar go for help with the other part of their problem? The low yen and high dollar.
We spent a lot of time in Washington. Our former chairman at that time, Lee Morgan, spent an inordinate amount of time in Washington lobbying to get the yen realigned properly.
Help for Caterpillar was on the way. In early 1985, just as Komatsu's challenge to Caterpillar was striking pay dirt, the exchange rate pendulum swung back, and the yen started up. New York's Plaza Hotel was the site of a late '85 meeting of finance ministers and central bankers that brought the dollar down lower and faster. Komatsu had turned the corner in the U.S. with a low yen strategy. Could it now switch to a strategy to deal with the high yen?
我々としてはやっぱりアメリカでビジネスを拡大する上では
In order for us to expand business in the U.S., we felt it necessary to produce and eventually develop products in the U.S.
Producing in the U.S. instead of importing from Japan meant not having to worry about yen-dollar exchange rates. A joint venture with U.S.-based Dresser Industries started with high hopes. But their organizational structures and corporate cultures never meshed, and the marriage ended up on the rocks. Would Komatsu go back to importing, or would it keep trying to supply the U.S. market from U.S. factories?
Komatsu products, intended mainly for the U.S. market, should be developed and produced in the U.S. and be supplied to the world. I feel this is the way we should go.
小松としては今のこの為替の変動というのをポジティブに
We want to react positively to the current exchange rate situation by pursuing our goal of developing, producing, and selling in Japan, the U.S., and Europe.
いうところに向かって小松はポジティブに対応しようと思っています。
Why was Komatsu, why were other manufacturers so determined to take on the risks of making their products around the world when they could make them so much more easily at home? Frank Manfredi, heavy equipment industry analyst and editor of Machinery Outlook.
All the major manufacturers are siting plants, or they have established joint ventures, or they have some sort of an affiliation, a licensing agreement, or something that allows them to build products in Europe, North America, and Japan, and so that they can shift production back and forth and take advantage of the low exchange rate one country versus another.
By any standard, both Komatsu and Caterpillar were major industrial powers, with billions in assets and sales. But in an era when corporate health depended on international competitiveness, shifting foreign exchange rates were a force, like the changing weather, that companies couldn't control, only adjust to.
So what impact do large exchange rate fluctuations have on companies like Caterpillar and Komatsu? Some time ago, I was joined by some of my colleagues in Melbourne, Australia, to discuss this case study. They are Hervé Torres of the International Monetary Fund, Rachel McCullough of Brandeis University, and Richard Snape of Monash University in Australia. Let's see how the discussion went.
Nariman, let's put it in perspective. Why was the Japanese yen so cheap in that first part of the 80s?
It was because of a combination of very expansive fiscal or budgetary policy combined with very tight monetary policy, which pushed up interest rates in the U.S. and therefore pushed up the value of the dollar. And interestingly enough, it was combined with the opposite kind of policies in Japan. And so it was the combined effect of those two that made the yen weak and the dollar strong.
So that balance is actually upset and in a sense then directly affects the competitiveness of a country.
Oh, indeed. Over that period, the United States was not competitive with Japanese and many other producers in not only in the United States market, but in markets in other parts of the world. It was United States consumers and manufacturers were importing, and exporters from the United States found it very, very difficult to compete. Now, what happened, of course, from all of that was with imports being encouraged, exports being discouraged, the United States had a big deficit on its the current account or the trade account, that is, importing a lot more than it was exporting. The other side of that was that the monetary policy that Nariman was mentioning, with the high interest rates in the US, was drawing funds into the United States, particularly from Japan, which was giving a surplus on the capital account of the United States. That is, it was drawing a lot more in terms of capital than it was sending to the rest of the world. Now, that deficit on the current account or the trade account then was the other side of this surplus on the capital account. The two together add up to zero.
Mm-hmm. But isn't there a spin-off in terms of inflation?
There is a close relationship between the rate of inflation and the exchange rate. If, for example, a country is running a high inflation, it has a high rate of inflation, and it keeps the same exchange rate, it will very quickly, the currency will become overvalued, and it will be cheaper for consumers to import, to bring things from abroad. In that case, the country will run very soon a deficit in his current account, and then the government will have to appeal to, for example, high interest rate to try to keep the money inside the country. And on the other hand, in some cases, a government may try to control inflation by fixing the exchange rate, trying to keep prices in line with the prices of his main trade partners. But in that case, if that government don't act in the other different sectors where the problems are coming from, then it won't work, because in a very soon time, as I said before, it will run a very important current deficit.
Then, I guess with exchange rates fluctuating so dramatically and sometimes overnight by the hour, what should a country do to try and minimize that risk? Nariman.
Well, as we'll see in sort of later discussions, I mean, countries have tried in the past to fix their exchange rates. But short of that, there are things that companies can as well do to account for short-term variations in exchange rates. They'll hedge in the exchange markets. They'll engage in a variety of activities. But in a longer-run context, as we saw in the case study, companies can make decisions to locate plants abroad, as Komatsu did in terms of sort of producing in the U.S. So it can have profound effects on the way that companies do business, where they produce, and so forth.
And was that the best option at the end of the day?
Well, in fact, because the exchange rate, the dollar rose and then fell and yen did the opposite, it turned out in retrospect that it was a very costly exercise on the part of Komatsu. And in fact, these big fluctuations in the dollar forced Komatsu to make some decisions that it otherwise might not have.
Thank you.
Let's see if we can summarize some of the impacts on the economy as a whole when a currency either depreciates or appreciates. First of all, let's look at a depreciating currency. We can identify at least 4 different impacts. To begin with, it lowers the price of exports. How does it do that? Well, as a currency declines in value, let's say as the dollar falls relative to the Deutschmark, then U.S. goods become cheaper in the world market relative to German goods. And so therefore, the demand for U.S. goods increases. The demand for exports out of the U.S. increases. And this has the effect of boosting sales in the exporting sectors and boosting jobs in those sectors. The flip side of this is it increases the price of imports. So let's say as the value of the dollar falls relative to Deutschmark, the value of German goods goes up, German goods become more expensive, so this reduces the demand for German goods in the U.S. It also has the impact, by the way, as imported good prices go up, then inflation can also rise in the U.S. because that's a source of inflation. Third, it can lead to higher interest rates in this sense that as the value of the dollar falls, the value of dollar-denominated assets falls or is eroded. So to compensate for this, foreign investors will demand higher U.S. interest rates to compensate for the fact that the value of their assets is eroding. Finally, a depreciating currency can twist the distribution of jobs and income in favor of the trading sectors or the exporting sectors and away from the non-trading sectors like lawyers and barbers and real estate agents, largely because this is where, that is to say, exports are where the growth opportunities are and where the job opportunities are. What about an appreciating currency, a currency whose value is going up? The results are more or less the opposite here, but let's go through them. First, it raises the price of exports. As the value of the dollar goes up relative to the Deutschmark, U.S. goods become more expensive. And so fewer of them are demanded, so the demand for U.S. exports goes down, and therefore the sales and job prospects in the exporting sectors goes down. Second, it lowers the price of imports. Again, remember, if the value of the dollar goes up relative to the Deutschmark is cheaper now, and so German goods and other imports are cheaper as well. And so that also has the beneficial effect of lowering inflation, especially in the imported goods coming into the U.S. economy. Third, because the appreciation of the dollar means that the value of U.S. assets has gone up, this means that investors are willing to accept lower rates of return on these assets. So often, an appreciating currency can result in lower interest rates. Finally, an appreciating currency, because it hurts the exporting sectors, tends to favor the non-trading sectors, which again are lawyers, barbers, and real estate agents. So as the opportunities decline in the exporting sectors, people will move into these other sectors. Now, we've seen the impact of a rise and a fall in exchange rates. And over the years, if we look at the last 120 years, there have been many attempts to, in fact, limit and fix exchange rates. And many of these have not been terribly successful. And we're going to look at a quick history since 1870 of attempts to fix exchange rates and what has happened. The first attempt was the so-called gold standard, which started in 1870 and went to the beginning of World War I. In this system, all the currencies were pegged to gold. Say, for example, that 1 ounce of gold was worth, let's say, $100. Now, if that began to change, for example, if the dollar began to appreciate relative to gold, then one way to correct for that would be to sell dollars or buy gold, to raise the value of gold, let's say, relative to the dollar. And vice versa. If the dollar depreciated relative to gold, then a country sold its gold reserves to sort of help raise the value of the dollar. But the goal here was to keep exchange rates in a very rigid kind of framework. The system worked fairly well, although a lot of people have argued that 1870 to 1914 was a period relatively free of shocks and turmoil. So as a result, this was not a fair test of any system. But nonetheless, it worked fairly well, and it came to an end with the beginning of World War I. After World War I was over, many countries allowed their currencies to fluctuate, but the result was a period of turmoil because of all the adjustments that especially the European economies had to go through this period. So there were a lot of exchange rate gyrations, at least in the early 20s. As a result of that, in the late 20s, many countries went back to the gold standard, but that was not very long-lived because of the onset of the Great Depression in 1929, which again brought about a collapse of this new fixed exchange rate, this new gold standard. And again, currencies began to move fairly freely, but the problem was that most countries got into what are referred to as competitive devaluations. In other words, they tried to devalue their way out of the Depression. And the logic was, as we talked before, that when your currency depreciates, it boosts your exports and jobs. And so that was fine, except that when everybody tried to do it, you had this sort of downward spiral of exchange rates and exports and trade, and it just worsened the Great Depression. When the Depression was over and World War II came and went, the countries, many of the countries around the world got together to form a new system, to put together the pieces again, and they put together what was called the Bretton Woods system. In this system, most of the currencies in the world were pegged to the dollar, and the dollar was pegged to gold. So it was a slightly different setup. And also a number of institutions were set up, multinational institutions like the International Monetary Fund and the World Bank, to help stabilize the balance of payments problems and exchange rate problems that were going to occur around the world. Now, the system worked fairly well for its first 10 to 15 years. It was fairly stable. But what happened was, starting in the early 60s, the U.S. started to run large balance of payments deficits, at least large by those days' standards. And also, the inflation rate in the U.S. started to rise because of the Vietnam War. And as a result, a lot of foreign countries didn't want to hold dollars anymore. Instead, they said, we want gold. And remember, part of this Bretton Woods system was that the dollar was linked to gold. And so for a while, gold flowed out of the U.S. But this created huge strains because the U.S. didn't want to give up all its gold, and it created a lot of problems. Eventually, the system collapsed, and in 1971, President Nixon severed the link between the dollar and gold, and that brought about basically the end of the Bretton Woods system. And in fact, in early 1973, all the currencies in the world de facto started to float. Now, what's interesting is that as soon as this happened, the global economy was hit with a large shock, which was the oil price crisis and the Arab embargo of 73 to 75. Now let's see how this new system of floating exchange rates that started in 1973 was able to cope with the shock.
The 1970s. Higher gas prices in the West. Higher revenues for world oil producers. Flooding financial markets with so-called petrodollars. In 1971, a monetary crisis had forced President Richard Nixon to take drastic action. But the oil shocks led to no financial crisis, no emergency economic measures. Why not? What prevented the monetary crisis that never happened? Exchange rates. Did floating rates work? Allied troops were still sweeping across Europe in 1944, trying to restore the world's political stability, when the resort town of Bretton Woods, New Hampshire, welcomed Allied economists to establish a new and stable world monetary system. They agreed on a fixed or adjustable peg system for setting exchange rates. The value of major currencies like the British pound and the French franc would be tied to the value of the currency of the only healthy industrial country in the world, the U.S. dollar. And the value of the dollar would be tied to gold. Exchange rates would be fixed the way decisions had been made at Bretton Woods by government officials. Under the stability of the Bretton Woods system, the economies of war-ravaged nations recovered and prospered. And a world economy that had spent a generation following American leadership developed many leaders. But a multilateral world economy operating under a U.S.-centered exchange rate system was a recipe for monetary trouble. Repeatedly during the 1960s, currency speculators would sell off large amounts of troubled currencies, forcing governments to spend billions to hold currency values up, only to be forced later to devalue drastically. More than a decade of crises came to a head in August of 1971.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
The closing of the gold window destroyed an essential element of the Bretton Woods system, the dollar's convertibility to gold, and currencies were allowed to float, to follow the market, while U.S. financial policymakers and their allies kept trying to patch the fixed rate system. But in early 1973, with no solution in sight, the world quietly gave up on the Bretton Woods system. Massachusetts Institute of Technology economics professor Paul Krugman.
There was not a day in March 1973 when policymakers suddenly decided that we should have a floating rate system. There was a day in March 1973 when speculators thought that such a decision might be coming and started moving vast quantities of money in anticipation of such a decision and forced the hand of the policymakers.
Now the market, not government officials, set exchange rates. Markets were subject to unpredictable swings and fluctuations, but many economists welcomed greater market influence on the exchange rate. And in 1972, one of them, George Shultz, became U.S. Secretary of the Treasury.
The market is influencing it no matter what you do. It's only a question of whether it's going on more or less constantly in exchange trading rooms, or whether it's a question of trying to build a dam at some point and the market forces hit the dam and finally they break the dam and the water floods over in a great sense of crisis and people travel to Geneva or Zurich or somewhere and have their pictures taken gravely declaring that they're going to defend these rates, and the next day, bang, the market breaks through them. So I think in that sense that the more market-based, directly market-based system is preferable.
But Edward Bernstein, one of the architects of the Bretton Woods system, thought market-driven rates could be clumsy and dangerous.
What the market doesn't do is act efficiently in the sense of properly giving you the right price. If the market makes a mistake on the price of wheat, it isn't so important. But when they make a mistake on the exchange rate, it's devastating because it covers the whole economy.
Just 6 months after the world turned exchange rates over to the market, the floating rate system faced its first test, the oil shocks of the 70s. Higher gas prices meant higher revenues for world oil producers, paid in the currency used for most international transactions, U.S. dollars, so-called petrodollars. Oil producers looked west for petrodollar investment opportunities. But could the floating rate system absorb the flood of petrodollars? Or would the tide of mobile capital swamp the new system as it would have the old, setting off another round of monetary instability? George Shultz said that a fixed rate system would have precipitated another monetary crisis.
The market would have forced changes, but they would have come in that same pattern that I referred to earlier, a big effort to hold on to rates that were increasingly seen as not right by the marketplace, intervention, which puts money in the pockets of the exchange traders, and then the dam breaks and the currencies change, and then you do it all over again.
Edward Bernstein acknowledged that floating rates had averted an exchange crisis, But as to stability,
Far from stabilizing the balance of payments or the exchange rates, the floating rates exaggerated it.
who was right? Had floating exchange rates served the world economy well during the oil shocks of the 70s?
The oil shocks were a terrible blow to the world economy. But what they were not accompanied by was any major international trade disruption. In fact, world trade continued to grow rather rapidly, rather smoothly, continued to be an engine for growth right through these terrible shocks to the international system. We didn't make the oil price increase painless, but we avoided having a lot of extra pain that might have come if we'd had some other monetary system.
It wasn't the last time that changing economic conditions gave exchange rates a rough ride. But floating rates made a rough ride just a little smoother.
How do economists feel about the relative merits of a floating exchange rate system and a fixed exchange rate system? Let's rejoin our panel in Australia and see what they have to say.
Nariman, what would have happened had governments kept exchange rates fixed during the oil shocks of 1973?
Well, because there was so much capital flowing around the world as a result of the oil shock, first from the developed countries to the oil-producing countries and then sort of back in the form of investments, it would have been very hard for governments to pick the exact exchange rate that the markets would have chosen. So the likely scenario would have been that it picked the wrong exchange rate. There would have been a series of sort of crises, a devaluation, let's say, and then the governments probably would have picked another wrong exchange rate and another crisis, instead of which they did allow the markets to equilibrate at the right rate, and therefore averted the crisis.
It would have been a perfect vehicle for speculation, in
That's
fact,
right.
because you'd attempt fixed exchange rates when you've got no real feeling for what the level should be is a perfect scenario in which for encouraging speculation against that exchange rate.
So can it be said that a floating rate is then always going to be, by its nature, better than a fixed rate?
I don't know that it can always be said, and one thing, of course, is that a floating rate is not necessarily a rate which is going to be moving up and down a lot. You can be floating in a bath, but it doesn't mean that you're going up and down with the waves. We don't have too many waves in a bath. Now, so a floating rate is not necessarily unstable. But a supposedly fixed exchange rate, which you're trying to peg at a rate that can't be sustained, can be a very unstable rate. So I think we should be very careful about equating floating rates to instability and pegged rates to stability.
Well,
Now,
I think that everyone would agree that one lesson of the 1970s and the 1980s is that the degree of volatility of market-determined exchange rates is greater than we thought before 1973.
Yes.
And in fact, the degree of volatility is greater even than the critics who were against floating market-determined rates had predicted. And yet, the effects of that volatility have been much less in terms of discouraging trade and investment. Trade and investment have continued to increase.
Oh, that's certainly true, and I think that the instability that one would have received from trying to fix in that period would have in fact been much more disturbing than what occurred with the floating rates at that time. Now, of course, everyone would love, I'm sure, to have fixed exchange rates that didn't move, and that makes planning easy and so on. But unless the governments have got the basic conditions and the similarity of the conditions across the countries to establish that, then it can't really be achieved.
It's interesting to draw a parallel between what happened in the mid-'80s with the U.S. and what happened in the early '90s with Germany, because the kind of policies that were being conducted were very similar, very expansive fiscal policy, very tight monetary policy. In the case of Germany, Germany was in a fixed exchange rates, more or less fixed exchange rate system with the rest of Europe, and that precipitated at least two currency crises during that period, in '92 and again in '93, whereas we didn't have that with the U.S. That's not to say that it wasn't a painful experience for the U.S., but it didn't trigger the kind of financial crisis that the Europeans went through under similar circumstances, but with fixed exchange rates.
Yes, I would say that Richard said, a floating exchange rate doesn't mean a more volatile exchange rate. Doesn't mean that there is going to be much more fluctuation than with a fixed exchange rate.
But I'm interested, is a chicken and egg, which comes first, the exchange rate or government policy?
I think always,
Both.
I think generally you can say that the government policy must be there. But in some cases, the government may try to provide an anchor for its own policies by fixing the exchange rate. Now, this is a very risky business, and many countries have tried it and failed because they haven't been able to discipline their own monetary and fiscal policies enough to, in fact, fit that fixed exchange rate. We have many examples where that's failed. And you're right, and there's a chicken and egg. There is a fundamental problem of getting those domestic policies right. The question is, what is the best way of getting those right?
And the difficulty, too, must arise when a government is hit by an external factor and they can't control it as much.
Right, and I would argue in that instance is precisely the instance where you do want flexible exchange rates, because I think we probably would all agree that essentially flexible exchange rates can become a buffer to absorb some of that shock. If you try to fix exchange rates in that environment, you can create other problems. The instability could show up elsewhere in the economy rather than in the exchange rate.
If, for example, there is an external shock that, like the one that happened with the oil prices when they all went down in the 1986, in some countries like Venezuela had a fixed exchange rate, then what happened is that the country finally lose all its reserve, international reserve, because it is receiving less foreign exchange and is selling this foreign exchange at the same price. Everybody wants to buy this foreign exchange because everybody knows that this exchange rate is not viable. And by the end of the day, the government is without any international reserve. If it has a floating exchange rate, immediately the exchange rate will accommodate to take into account what has happened in the international market.
There's no doubt that an attempt to fix an exchange rate, when in fact the fundamental policies are such that it can't be sustained, gives an absolute bonanza to speculators, because the rate can only move one way. And so everyone will bet on that. A very good example, as far as I'm concerned, is that in Britain in 1967, they tried to maintain a fixed exchange rate that couldn't be sustained. I happened to be in Britain at that time, and when an old school friend came into me in the morning and said, well, how can he speculate against that? I thought, well, it was time for even an economist to contemplate that. And I made fully £7 on it.
And I guess that brings us back to the bottom line as to why exchange rates are important to a country, because they really need it to keep that balance in terms of what they're producing.
Well, I think that's true when a country competes in any industry with its counterparts abroad. The terms on which it competes depend critically on the exchange rate. So, for example, if a U.S. car producer is competing with a German company, then that German car that's priced in Deutschmark will look like a bargain at one exchange rate and will be too expensive for anyone to contemplate at another exchange rate. So whether the competition is fierce or pussycat depends a great deal on the particular level of the exchange rate just then.
And so, I mean, at the end of the day, though, would we opt for a floating exchange rate every time over a fixed?
It's kind of important to realize that we don't choose between floating and fixed. We choose between floating and temporarily fixed. And so the question is more, is the disruption greater from the day-to-day and month-to-month fluctuations, or from the larger jumps of 10, 20, 30% that we see in temporarily fixed exchange rates?
Rachel, thank you.
Let's see if we can summarize the arguments in favor of and against floating exchange rates. First of all, the arguments in favor. The first, and perhaps most important, is that it's the most efficient exchange rate system. What do we mean by this? Two points to be made here. The first is that when you fix exchange rates, all other prices in the economy have to change for an adjustment to take place, let's say to an oil shock. Whereas in a floating exchange rate system, the other prices don't change, but the exchange rate changes. So only the exchange rate needs to change. So that's a more efficient way of handling a shock. A second reason in favor of floating exchange rates is it provides policymakers, in the U.S. that would be the Federal Reserve or the U.S. Congress, it gives them more autonomy. Since they don't have to focus their energies on fixing the exchange rate, they can devote that energy to more important factors and variables and goals like the unemployment rate or the inflation rate. A third reason in favor of floating rates is that it allows for small and continuous changes in the currency, whereas fixed exchange rates, often when they come under a shock or an attack of speculative attack of some kind, usually when they go in a big way, and you see a big decline or an increase in an exchange rate in that kind of a situation. There's a long history of those. Fourth, as we saw in the petrodollar story, floating exchange rates are much better able to absorb big shocks like the oil crisis. And finally, floating exchange rates eliminate the need to buy or sell a lot of foreign exchange in an attempt to keep the exchange rate fixed, and therefore are less costly from that perspective than a fixed exchange rate system. What about the reasons against floating exchange rates? And we've listed 5 of them here. To begin with, one of the arguments has been that it lacks discipline. In other words, the system doesn't discipline policymakers. Because they don't have to worry about the exchange rate, they are more tempted, especially the central banks, and in the case of the U.S. it would be the Federal Reserve, more tempted to be more inflationary. So the notion being that accompanying a floating exchange rate system is higher inflation. However, the experience since '73 does not bear this out. And in the last 20 years, inflation, if anything, has gone down, especially from the early '80s on, largely because even though exchange rates were floating, monetary authorities, including the Federal Reserve, were very able and successful in controlling inflation and reducing inflation. A second argument against floating exchange rates is that there can be destabilizing speculation. Again, no evidence of this in the last 20 years, although occasionally exchange rates will overshoot their target, if there is a target, or will go a little too high, but eventually they equilibrate and come back down again. So again, no evidence that this is a serious problem in the last 20 years. Third, and this is a serious concern, is that floating exchange rates can actually hurt international trade. And the notion here is what came out of the Caterpillar and Komatsu story, which is that very large swings in exchange rates can in effect be like a tax on trade. I think this is a legitimate concern, but again, the evidence in the last 20 years doesn't bear out the extreme concerns, namely that growth in trade, growth in GDP during the last 20 years when exchange rates have floated have not been any lower than they were in the prior 20 years when exchange rates were fixed. The last 2 criticisms against floating exchange rates are in fact quite serious ones, namely that what floating exchange rates in effect have allowed countries to do is to get away without coordinating their policies very effectively. And in fact, there were periods in the 1980s during the floating exchange rates then that German policy was going one way, U.S. policy in a different way. And so this does not discipline policymakers, doesn't force them perhaps as much to coordinate their policies. And in fact, brings us to our last criticism of floating exchange rates, which is that while floating exchange rates give the illusion of greater autonomy in terms of policy, the reality is that even under floating exchange rates, policies in one country have a big effect on policies in another country and the economy of another country. So that U.S. fiscal policy in the 1980s had an impact on Germany and Japan and so forth. Now, the debate about whether or not we should have fixed or flexible exchange rates or floating exchange rates is going to go on. It's one of those kinds of debates that's not going to get resolved anytime soon. However, certainly the experience in the 20th century supports the case for flexible exchange rates with one major caveat, and that is that the experience of the 1930s and the 1980s with large fluctuations in exchange rates suggests that a floating system without close policy coordination is not going to function very well. For Inside the Global Economy, this is Nariman Baravesh.
Annenberg Media. For information about this and other Annenberg Media programs, call 1-800-LEARNER and visit us at www.learner.org.